All right, good afternoon, everyone. Welcome to another live webinar today with Peter and Darren. So they're going to be talking or having a conversations on the property and capital gains tax. So if we haven't met, my name is Jonathan Wu. I basically manage the marketing team at Master Capital Group. If anything I can assist you with and all that, so please feel free to get in touch. All right, well, first of all, welcome our special guest, Darren Jinkins. Welcome, Darren.
Thanks, Jonathan. Thanks, Tesla. Thanks, Pete.
Well, so good to have you. All right, and next we have Peter Hutchinson, our very own Managing Director at Master Capital Group. Welcome, Peter.
Thank you, Jonathan, Tesla, Darren, all good team here.
Well, looks like we're running two shows, consecutively weeks. So, and there'll be more to come now that the new COVID restriction sort of coming to place today as well. So it looks like live webinar is going to be another hot topic again. Saying that other than that, okay, well, welcome Tesla.
Thank you, Jonathan. Welcome, guys. Thank you.
Now, if you have any questions and all that, please feel free to put in the chat, and Tesla will facilitate that for us. Thanks, Tesla. All right, I think first of all, just have a bit of a conversation with Peter, if it's okay. Well, Peter, you obviously representing the captain of the ship, Master Capital Group. So maybe perhaps you can tell us a little bit more about the Master Capital Group, what we do and services that we provide, and maybe introduce a little bit about our team and all that. Please, Peter.
Sure. Thanks, Jonathan. Well, a little about Master Capital. We're an equity funder. We provide equity to developers and or entities that are requiring capital raising. We have an AFSL license. There are 4 RMs, responsible managers on our license, being John, Evan, Tesla, and myself. And so we are licensed to be able to raise capital and talk about securities and product advice on our license. From our side of it, a bit more around some of the projects. We're a developer in our own right, but we also assist many developers in doing joint ventures and working with them on the capital raising and or senior debt requirements as well for projects. So we've been now clients with Hock for a lot of years now, and we'd like to introduce Darren and a little bit about Darren and winning some awards the last couple of years. So Darren, maybe you'd like to share a little bit about Hock and the services that you provide.
Yeah, thanks.
All right. Well, you're doing that. Actually, what I do is that I'll remove Tesla and myself out so that two of you can sort of carry on with the conversation and leading on to the topic of the capital gains tax as well, if that's okay. So, all right, I'll let you two of you take the stage then. Thanks.
Thanks, guys. Yeah. Pete, as you all know, we're a probably medium-sized accounting firm based in Essendon. We're probably 16 staff. We do a lot of individual tax returns, a lot of business tax returns, and quite a few self-managed super funds. There's 3 directors, myself, Michelle, and Lisa. Lisa sort of specialises in self-managed super funds, and her and her team have won a number of Australia-wide accounting awards over the last few years just for their work in the super area. So Lisa and her team are very good at what they do. Michelle and I probably tend to look after more of the business things, so we sort of get thrown a lot of different sort of queries from week to week. We're not necessarily masters of any of them, but we know what the issues are, and if we don't know the answer, we'll push the person in the right direction. I mean, there's always tricky things with tax, as you well know, Peter.
Yes. Look, I think it's probably one of the best things that it's about being transparent with everybody as well, and not just from your side of it and our side of it. Is that there's no necessarily one right answer, and tax is a tricky area, and that's why you've got to get specialist advice, and particularly around property and and even the topic that we're going to talk about today, capital gains tax. It's one of those areas that gets dismissed quite easily by particularly in property developers and or investors. And so we thought we'd a little bit of a question and answers for yourself and investors and whatever can come back to you and talk to you directly about the tax implications from that side of things as well. So maybe we could sort of touch base. Is the first one off the rank is what is capital gains from, and leave fire questions at you.
Well, I suppose a capital gain is basically a profit on the sale of a capital asset. I mean, and in terms of what the definition of capital asset is, we could probably spend a couple of hours on it. But most typically, it tends to be real estate and shares. And I suppose for the purpose of our discussion, we could probably focus on the property side of things. So, in a property, with a property sale, the capital gain, now this is excluding main residence, which we'll get to later, but the sale of a property will generally trigger a capital gain. That'll be worked out based on the cost base, which is basically how much you paid for it plus your purchase costs, typically stamp duty, less the sales proceeds. So what you got for the property, less your selling costs. If you've held the property for more than 12 months, you'll get a 50% discount. But I suppose that's basically it in a nutshell. It works the same with shares as well. What you paid for the shares, less what you sold them for, and you deduct the purchase costs and the selling costs to work out your gain. So I think that's pretty much it in a nutshell, Pete.
And that really comes down to how the calculation for capital gains comes into it. And I guess everybody's circumstances is going to be different, and getting good accounting advice right from the start. And I guess that's something that I say a lot of the time is begin with the end in mind. Is whether you're going to be selling shares or company shares and that sort of thing, or property. Looking at when you're selling them, when the capital gains is going to actually be realised, and that really comes down to another another topic around the structuring side of things. But and that's probably not yet for today, but maybe some of the you sort of elaborate on some of the how the gains is calculated. That'd be a handy thing for investors.
Well, a common misconception is that capital gains tax is its own tax, but it's not as such. As we discussed before, you work out what the capital gain is. If you've held the property or the share for more than 12 months, you get a 50% discount. So that reduces the taxable amount down by 50%. That amount goes into the tax return of the person or the entity that owns that asset. So depending on what the marginal rate is for that person, or if it's a company, it's going to be a flat rate. If it's a trust, it'll flow down to the ultimate beneficiary. But at the end of the day, it depends on what that person's taxable income is. Now, if you've got someone who's on no income, well, they're going to get the benefit of the low tax rates. If you've got someone who's already on the top marginal rate, well, the tax on their capital gain is going to be at the full marginal rate.
Yeah. So that is after that, whatever they've earned for the year on their financial, whether they're an employee or any other. There can be a contractor or whatever. It's their income, and then the capital gain is calculated after. Spot on. There's a couple of things you've got to be wary of too when you're selling a property. It's based on the contract date, not the settlement date too. So a lot of people come in and they say, "Oh, I need to, let you know I've just sold my property, and it might be the middle of August," and they consider the sale date to be the settlement date. But you need to go back and ask them, okay, well, when did you sign the contract? In a lot of cases, they may have signed it in the middle of June. So you have to break it to them. This gain won't be in the current financial year. It'll be in the year that's just finished. So just need to be wary of that. A couple of situations where if you've got a property that maybe the contract's signed today, for example, and they'll say, if it's a big property deal, they might say, well, okay, well, it doesn't settle for 4 years. A lot of the developers, Pete, they can push out the settlement date for years. Now, the capital gain will still be in this financial year, but when it finally settles, you need to go back and amend the 2021 tax return to include the capital gain. Now, this is because if you put the capital gain in the 2021 tax return, the people won't have the money to pay the tax. So it's not fair to be paying
paying tax on money that you won't receive for 3 or 4 years, because obviously, you know, a lot of people won't be able to fund it if they haven't received the proceeds. So there is little intricacies like that that you need to be aware of, but it'll generally be the contract dates that's the relevant one. There's also just in relation to assets. Now, the sale of a business is also the sale of a capital asset. So you'll generally get the 50% general discount, so that will reduce the gain down. With a small business, and look, there is a lot of criteria that you need to tick, but there can also be another 50% discount. So effectively, the taxable portion will be 25%. And then in a number of circumstances, you can either take the money tax-free, or you can roll it into superannuation to reduce that gain down, and sometimes possibly to nil. But that gets very complex with the small business concessions, and there's a pile of boxes that you need to tick to make sure that you're eligible for that. So always seek advice on that.
Yeah, I can speak for myself on that one. It's I had that same situation back in 2008, and Hock, governed the way through it and reduced the tax significantly, all legal, of course, and part of it went into super and things like that. So there was a good, it's a business planning, and part of that is also when I look at things, it's not just what are you doing now. Are you seeing your accountants at this time of year? Have you already seen them 2 or 3 times a year? And yes, you pay for that service. However, the gains that you'll get, and similarly, only last year we settled on 2 properties, and one was in June, or the signed contracts were in June and August. So, good example of what you just brought up. But the 2 different tax years meant the capital gains and when it was calculated, and it was for the client, probably 14,000 just on that alone.
And in a lot of circumstances, if you get your account involved in the way the sale of a business is structured, it might make it easier to access those small business concessions. And a lot of the times, you may be better off receiving a lesser amount and getting access to the small business concessions rather than receiving a higher amount for the sale of the business and paying tax on it. So it's always worth a conversation if you're looking to sell a business.
Yeah, one of the other questions that always comes down to is there's a big exemption from capital gains. My understanding on the family home or main residence. You are able to elaborate on that and what you need to look for and the things that are implied on a family residence? Yeah,
well, I mean, this is probably the biggest exemption, and it can also be the trickiest. But obviously, most people have a main residence, and in a lot of cases, they'll have a rental property as well. So there's a common misconception that someone might have a rental property and they might sell their main residence, and they think that they'll live in the rental property for a couple of months or 6 months, and they'll sell that tax free. Well, that's not the case. You can't have 2 main residences at the same time. There's a small exemption if you're buying one and selling one, which I think is about 6 months. So if you're moving out of your current main residence and moving into another main residence, there's a 6-month period where you can have 2 main residences, and it won't affect the tax-free status of either of them.
On that point, and this is probably a live question, which probably isn't, throw it in anyway. If you were to make a capital gain on that second premises, so you live in one, you're going to move into another one which hasn't settled yet. If you did a substantial change, you did a renovation or something major, some uplift, and you built an additional property or anything like that, how would that impact on the second residence, or would it just get wiped altogether?
Well, it can get a bit tricky in terms of, because if you're living in your main residence, and then you move to another property, and then your main residence then becomes a rental property, what you can do at that point in time is get a valuation of your old main residence at that point in time, and that can form the cost base for when you eventually sell it. So ultimately, you're only paying tax on the uplift or the increase in the value from the time that it ceased to become your main residence and was rented until the time you eventually sell it. Conversely, if you've got a rental property that then becomes your main residence, what you need to do is work out the number of days that it was a rental property and the number of days that it was a main residence, and you apply that percentage to the gain.
Yep.
Getting back to the substantial renovation, that will count towards the cost base, but then if it's a main residence, it may not matter at that point in time anyway.
Only if you then sold the second property, within the 12-month period, would you? And
correct.
Where we get, where we sort of sit on it a lot of the time from our, not that we do renovations, but one of the things that we look at is from just the capital gain. But for me personally, it would then be about, well, what else are you doing with it? And did you get the tax advice at the time? Because there's a lot of implications, whether it was in a company, whether it was best use of your funds. Is that an investment decision? Because you can't claim then the renovations if it's your principal place of residence. So
yep, yeah.
There's
one of the big the big exemptions, I suppose, in relation to main residence is if we pick a scenario, for example. So if you're living down here, Pete, and you've got your main residence down here, for whatever reason, you have to go up to Sydney to work, for example. So you go up there for 4 or 5 years, you rent up there for the period, you rent your place out down here. Now, as long as you move back into your property or sell it within that period, you've got 6 years where it can still remain your main residence. And this is on the basis that you haven't purchased a property up in Sydney, so you've still only got the one main residence. Regardless of the fact that it's rented, you can still access the main residence exemption on that property. So that's created a lot of strategy around what property will be your main residence and what one won't be. A lot of people own more than one property. What one do they claim as their main residence? What one don't they? You need to make people aware that they have the ability to still claim that one as the main residence up to that 6-year period. This has been used a couple of times. I know we've briefly spoken about this before, where people come into the country, they become Australian residents, and as Australian residents, they're taxable on their worldwide income, including capital gains. Typically at the point in time when they enter Australia, so let's just say the person has a property in the UK that was their main residence. At that point in time, they need to get that property valued and convert it to Australian dollars so they know the value of it, because that will then become their cost base for any capital gain down the track when they eventually sell that UK property. If they don't buy a house here, they still have the ability to claim that property as their main residence for a period of 6 years. Now, you'll probably find most people will buy a property within that 6-year period, but it does give them a bit of scope to maybe push that date out, and hopefully the value of the property has gone up, which means they pay less capital gains tax here. Yep. But I mean, it's often subject to the exchange rate as well. So sometimes you might find that the value's gone up, but the exchange rate works against you, so it ends up lower. But I mean, typically the property is going to go up. And the who knows what the exchange rate will do. But they're the sorts of things you probably just need to be conscious of.
Again, that comes really down to your tax planning and seeing your accountant on a regular basis, not waiting until after the end of the financial year and then go, now let's have a look at what we've already done, because it's a bit hard to funds or.
Well, I think there's probably a general conception that I haven't brought any money into the country, so it's without beyond the jurisdiction of the Australian tax office, but that's not the case. Unfortunately, as an Australian resident, you're going to be taxable on your worldwide income. So, but I'm sure there's still plenty of properties overseas that the ATO don't know about. But I mean, that said, the ATO are getting a lot better with these things. I mean, typically to the point where when we do the pre-fill to do someone's tax return, there'll be details of the property that they've sold during the course of the year. So the ATO are basically saying to us that we know that you've sold a property. They don't know if it's a main residence or it's a rental property. Well, I mean, that said though, if it's been rented, they'll be able to check in your tax return to see if it's been rented. But it could be a holiday house that, you know. But I mean, that said, holiday houses still caught. Main residences will be exempt. So that's why typically, even if a main residence is sold, we'll put the details of the capital gain on the main residence and then indicate that it is a main residence, but it's exempt. Because if you put nothing in there, there's a chance that the ATO may give you a call, you know, probably 12 months after you've lodged your tax return and say, look, we know you sold this property and there's no capital gain in your tax return. So what's going on? Obviously it's a main, well, in this scenario, just say it is a main residence. That's easy to fix, but you still have to correspond with the tax office just to deal with it. So that's why we tend to put them in, just to clear it up. Just trying to, if there's any other points we need to make about that. Oh, capital losses. So if you sell an asset and you make a loss on it, you can only offset that loss against capital gain. So if you've made a capital gain during the course of the year on one asset and you made a capital loss on the sale of another asset, those two will offset. If you haven't made a capital gain during the course of the year, that capital loss will carry forward indefinitely until you do make a capital gain. And at that point, the loss will be absorbed to reduce your capital gain in that particular year. In your case, Pete, as you well know, it's because you're looking to buy properties, develop the properties and sell them. That's not a capital gain because that's on revenue account because you're in the business of doing that. And that's the same with anyone. If they're in the business of buying property and selling it, then they're that will be on revenue account. So the difference being that they won't get the 50% discount.
Yeah. And I think it's pretty important to bring those points up. You know, they're valid points. When you're looking at tax, you know, it's not just one boot fits all. You know, and just because it's one person, whether it's a development, whether it's in a company, whether it's a company in trust, you know, whether the funds have got to be dispersed through the company, through the trust, you know, those things they're all various, you know, areas that all require tax specialists. So hence why we come to you. And
yeah, well, typically, if someone comes in and they've had a main residence and they've had a rental property and maybe they flick between the two in terms of where they lived, I'll generally sort of try to do a bit of a timeline from when the properties were first purchased and when they moved in from one and out of the other and so forth, and when the main residence first became available for rent, those sorts of things. So you get a full picture. So you really need to ask a lot of questions about this because it's fairly common. I mean, obviously, you know, most people have a main residence and a hell of a lot of people have a rental property these days too. And a lot of those rental properties have come from maybe being a main residence and they thought they'd keep it rather than sell it when they bought their new place. So you just need to get to the bottom of all that sort of stuff. But I think we're probably getting a bit short on time, are we, Pete? Or?
Yeah, sounds like. Well, Jonathan's popped up, so...
Yep. Now, saying that, actually, there's a lot of scenario there. That's why I thought I should put up the disclaimer to say that, well, even the information that provided by Darren or the conversation that Peter is having earlier, this is just in a general in nature only. Obviously, it does not constitute any personal financial advice or anything like that. So before you're making any decision, it's best to basically either talk to Darren or your accountant or your a legal advice for professional advice, of course. Otherwise, feel free to get in touch with us. So I thought I'd put it out there just in case.
Yeah, I mean, the worst case scenario is we can't help with the capital gain, but we can roughly give you an idea of how much tax you will pay and when it will be payable. So once you get the proceeds from the sale, you can at least put some money away to cover the tax. Yeah.
Now, I think Tesla also got a few other sort of related questions to that as well. So I'll invite Tesla to come on stage as well to just ask a few questions.
Sure.
Shoot, Tesla.
So, Yep. Hi, Darren. Yep. Yeah. So actually, one of the questions is that, if the parents want to sell the house to the kid, like, is there any exemption on the CGT?
No, well, I suppose the question is, are they going to sell the property to their kids, or are they going to gift it?
Well,
Yeah. If look, I mean, you can gift the property to the kids. Only issue will be if it's less than, well, even if they sell the property to their kids and it's at less than market value, the ATO will deem that to be a sale at market value. So there's market substitution rules which kick in, and basically you'll pay tax on the market value less the cost base, regardless of whether it's gifted or whether it's sold for half price or whatever. I mean, that said, if it's a parent's main residence, then there won't be any issue there. But if it's, for example, a rental property or a holiday house, then there'll be capital gains implications.
Okay.
Yeah.
Fair enough. Okay, cool.
Just with a holiday house, a lot of people have holiday houses. Obviously, they're not getting any rent for them. But let's say they purchased a property back in 2005, and over the years they've had council rates and land tax and water rates and repairs and maintenance. All of those costs that they've incurred over the say 10 or 15 years, they can be capitalised onto the cost base. So if they spent say $200,000 back in the early 2000s, and then they've spent maybe $15,000 over the 15 or 20 years that they've held the property, that will bump up the cost base to 2015 or whatever those costs are. So it's always important to keep track of all of those costs if you've got a holiday house.
Okay, I see.
That wouldn't be necessary just for the 7 years that you require the tax side. If you're keeping that property 20 years and you want to evidence that, I would be then saying that you'd probably need to make sure you keep those what you've spent over the 20 years.
Well, that's right. I mean, the capital gain may well happen in this year, so you need the evidence to back up your cost base, going right back to day dot.
Okay, cool.
Not that many people do, but it's
okay. So, yep. I think we can move on to the next question. Kind of like from the State Revenue Office point of view, how does the stamp duty impact on just the structuring?
Well, structuring is probably it's probably more about what the property is going to be used for. Stamp duty is going to be the same sort of across the board. So stamp duty comes into it if you've got a property in one entity and you want to move it, you're going to cop stamp duty, even though it's going to be moving within the same group, if you like.
Yeah.
You're going to cop stamp duty. So you really need to, when you're doing your structuring, make sure you get the structure right, because you don't want to be getting 12 months down the track and coming to the conclusion that this structure isn't right. We should have been in this structure. Well, you're going to have a stamp duty problem. So you need to put some real thought into the right structure. If it's going to be a main residence, it needs to be in a personal name. You can't own. Well, you can. You can purchase a property in a company and then live in it, but you're not going to be able to claim your main residence when you sell it. So generally, it's better to have a good think about who's going to own it.
So it's okay to do the trust? Can they still claim the main resident? If it's a
not in a trust.
Not in the trust also.
No.
Oh, okay.
But the trust has another benefit, and we did this last year, where we had a trust and a company, a trustee. We changed the trustee over, so even though that's the company is changing, the ownership didn't change. So the unit holders in that trust were still the unit holders, and we only changed the trustee when it came to getting the second mortgage.
Yeah, you're probably going to please explain though from state revenue though that with those sorts of deals.
Yep, we did.
As you know.
Yeah, so we did that. We went back to the State Revenue Office. We declared it. We had to show how the trustee was changed. And this comes around to more around probably the AFSL
Yeah.
side of things and understanding the structuring around it. For us personally, we had documentation, we had the minutes of the trust, we had the unit holders agreements, and everything went transferred through. They took a week or two, came back to us and said, yes, there's no stamp duty required to be paid, and we have it in writing. So we had that to go back to investors with as well. But understanding the process is a little bit more complicated than just the just swap it over to another trustee.
Yeah, well, I mean, in that situation, there may be a change of trustee, but there's no change in the beneficial ownership. But unfortunately, State Revenue just see the trustee because they're on title, so their first reaction will be to levy stamp duty unless you can sort of explain your way out of it.
Okay.
Yeah.
Okay, so let's go to another question. I think some of the question probably I think a lot of people would like to know, one day, is a deceased actually estate or inheritance subject to CGT? Because, especially the parents that pass away and then, the kids actually pick up. What's going to happen?
Yes and no, Tesla. Yes and no. If the person who passed away, if it was their main residence, then you've got 2 years to sell the property, and it will still be tax-free. After that point in time, you're going to have a capital gains issue. If it's a rental property, now there's a couple of things that can happen. The estate can sell the property, and the estate will pay tax on it as if it was the deceased person. So they would go back to their cost base, and this becomes a bit of a problem for the kids. In most circumstances, they're going to go back through their parents' documents to find out how much they paid for that, that place down at Phillip Island that's been the holiday house since the mid 1990s or something, and do all the calculations on it. But it will certainly have capital gains if it's not the main residence. If the property is passed out to the beneficiaries, then they will inherit the cost base from the deceased person, if you like, through the estate. So it's important to keep records for all this sort of stuff. But yeah, look, your main residence, should be tax free.
But what you're saying is it's only for the first 2 years, because subsequently, after the 2 years, they will still need to subject to the CGT. Is that correct?
Correct. Yep. So if it goes past the 2 year period, the cost base will be the value of the property at date of death. So if mum or dad passed away today, you get a valuation of the property as at today. After 2 years, so what's the date? 25th of May 2021. So after the 25th of May 2023, if the property hasn't been sold, then there will be capital gains on the property when you sell it. Now, the calculation of that capital gain will be what you sell it for, less that market valuation as at the 25th of May 2021.
Oh, I see. So
there was a loss. As in, let's say the value of the property was $2 million. Doesn't pick a figure. So the value of the property is $1 million at the time of the death. But let's just say the market has turned significantly, and 2 years later, or 18 months or 2 years later, when they actually sell it, it's calculated it would be less. Is there a
yeah, well, typically you'd have a capital loss situation, but I'm not sure whether that applies in this situation. I'll assume so without having actually researched it. Thanks for that, Peter. So that one out of the blue. But I mean, there's not too many properties, I suppose, that have, or certainly in Melbourne, that have reduced in value over sort of a 2 year period. I mean, that's not exclusive.
I see. That's interesting. Okay, cool. Well, okay, I kind of actually have a last question. I think a lot of people, some of the people might want to know that anyway. So, so what happened if the marriage actually break down a relationship, and any impact?
Yeah. Well, the main residence is going to be tax free regardless, depending on who sort of stays in the main house. But if, for example, there was a rental property, the person who gets that rental property will inherit the cost base from the spouse. So if I owned a property a rental property with my wife, and let's say it cost us $100,000 back in 2010. Actually, 100,000 is probably a bit light, isn't it? But anyway, let's just say, then we separated. Obviously, my cost base would be 50,000, and her cost base would be 50,000.
Okay. Got it.
If I kept the property, my cost base would then be 100,000. So I would basically inherit her cost base. When I eventually sold it, I'd be paying tax based on the proceeds of the sale, less that $100,000 cost base. Yeah. So you sort of get, even though there's been a change in the owner on 50% of the ownership, you effectively get rollover relief. So that doesn't trigger capital gains tax. So you just inherit the other person's cost base.
Okay, got it. Okay, cool. I think probably that's all the questions I have for the time being.
Okay. Well, basically, if you have any more questions, feel free to get in touch with Darren or Peter. Now their contact is on the screen, or you can scan the QR code there. Will go directly to the landing page. So other than that, thank you very much, Peter and Darren. That was very interesting topics.
Yeah.
Sure, we can springboard to many other subtopics from there as well.
Yeah, happy to help.
Thanks, Jonathan. Yes, thanks, Darren. Good information.
Yeah, thanks, Pete. Thanks, Tesla.
Really insightful. Thank you.
Yeah. Thanks, guys.
Excellent. All right, do keep in touch, everybody, and stay safe. All right, bye for now, everybody.
Okay, all the best.
Thank you. See ya.
See ya.